Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So now let's get started with a brand new chapter called as Capital Structure Decisions. So technically this chapter name as per the Institute study material is Financing Decisions hyphen Capital Structure. So basically you can even call it as Capital Structure Decisions. Yes. So before we get started with this chapter, so I would just like to share a small story and then we can just get into the technicalities of this particular chapter, right? So how many of you know this guy called Jack Ma? Yes, you know this guy called Jack Ma? Yes, right. So this guy is actually, those who do not know, so he is basically from China. He's the founder of the company called as Alibaba, Alibaba Group. So Alibaba Group, again, for those who do not know, so if you see in China, they never let any kind of external be it external apps or external anything that is outside the world. What they will do is they will do a duplicate and that will be circulated inside the country. For example, duplicate as in not every time it's a duplicate. They always want something that is homemade, right? The indigenous product. For example, Flipkart and Amazon is there in India, but Flipkart and Amazon cannot be there in China. So in China, the biggest e-commerce operator is this company called as Alibaba, right? So they have this particular e-commerce website wherein you can go and purchase all kind of things, and it's not just confined to China. Even in India, you can place orders on Alibaba if you want to import something from China. It's a very, very big company right now. You have to see their office. They have just made it completely mechanized with all kinds of robos and all that. Excellently made. And the founder of this company is a guy called as Jack Ma. So I'll just tell you what this person is, what this guy has he's achieved, what he has done and all. Of course, there are always two sides to every person. So there are some criticisms placed on it. But there is something that we all should learn from this person. And that is the reason why I'm sharing a story with you guys. Now, this guy was actually born in a rural village in China. And generally in China, they don't speak any other language apart from their home language, which is not Chinese. What is it? Mandarin. Okay, fine. They have their own language. Okay, Chinese is the people who live there. Chinese is not the language. They have their own language. They speak that, right? So this guy, Jack Ma, is a small boy. He was always fascinated to this language, which is English, right? So because somehow he was fascinated to that. So what he used to do is, when foreigners used to visit China, he was the only guy who knew English in their entire village. So he used to act as a guide for them, and he used to get some pocket money and all that. So that's how he improved his language, by speaking with people and all that. And as he grew up, so he always wanted to be an English teacher because he fell in love with that language. So he wanted to be an English teacher. And so what he did was he tried so many things in his life. Like he wanted to get into Harvard somehow or the other. 10 times he made an application. All the 10 times he got rejected. Now he didn't know what to do with life. So he wanted to join, this KFC, Kentucky Fried Chicken, that group of the chain of restaurants, KFC. He wanted to go there and join as a waiter. So they had interviewed 25 people, including this fellow, including Jack Ma. Out of this, 24 people got selected. He was the only one to be rejected. They said, you are not even fit enough to be a waiter. That is how his beginning, that is how literally his adulthood began. So everyone started teasing him for whatever he was looking like and for whatever he was not able to do. People used to call him as fit for nothing type of a guy. So now what happened? This happened somewhere in the late 1990s, somewhere in the year 97, 98, 99, around that time. That was parallelly the time, by the way, when Jeff Bezos, he started with his Amazon. And that was parallelly the time when this guy, Elon Musk, he started off with his startup. What is the startup he started off? PayPal. The first startup that he started was PayPal. In today's world, it's called as PayPal. Back then, it was some other fintech startup. It was being bought up by another company. I think it was bought up by IBM, and they've renamed it and all. But anyways, he parallelly started that. But there was no internet and all. Internet was getting started. That was the time internet was getting started. And this person, Jack Ma, he was completely fascinated by this concept called internet. Now, today, people who, especially the 2K kids and all, So you might be born with a gadget, or maybe few years into your school, you might be having a mobile and all. But back in those days, not even too earlier, maybe some 10 years or 10 years before you guys were born, in case you are 2K kids, I'm just telling you, so 90s kid, fine. So maybe a few years before you guys were born. So we didn't have this concept of mobile phone, right? So we have seen that transition. So that is something that we can relate to. Of course, I think you guys can also relate to some extent. So what happened was, that was a time when even mobile phone was first introduced, and then slowly the concept of internet kicked in. Now, at first, when the concept of internet came in, people didn't pay a big attention to it. They didn't know that 10-20 years down the lane, the entire world is going to be a digital world because of this concept called as internet. Internet is nothing but networking, that's all. But a global networking, a big network is called as internet. That's about it. But many people couldn't realize. What if I tell you that maybe 10 years down the lane, artificial intelligence, or even not even AI, let's say this blockchain technology, this is going to be the order of the day. Maybe today we might not see what internet is the maximum thing possible. What else can be possible? Unless and until something really shows you results, you will not be able to believe. So it was at a very, very beginning stage. It was at a very beginning stage. That was the time when Jack Ma said, this is a beautiful concept where people can connect with people anywhere in the world. So what he did was, he had a business idea. He said, instead of me having a physical shop and selling the products, let me float it online on the internet, right? So I will open something called as a website with URL and all. So let people come and let they buy. Today it might not be a big deal because we are doing it left, right, and center with a click of a button. We have mobile applications and all. Back then, computer itself was a big thing, right? And over and above that, internet is even more a bigger thing, bigger concept. It was just beginning. So what he did was, he said, yes, I'm going to start this company called as Alibaba Group. So he and a couple of his other friends, so a few of them, these guys started. Now what they did was, they opened a website and they placed these product. When in 1998, 1997, at that point of time itself, he had this idea, right? He put these products there. But the problem was what? Market didn't have the education. That is, people didn't know this concept of internet. They didn't even know that you have to go into a computer and that needs to have an internet connection and all. You know what he did? He never gave up on this thought. Many people criticized him like anything. They said, oh, you are actually dealing with some silly project. What is this going to do? You can't even see the product that you go to sell. You're saying some internet nonsense and all. How is this going to work? What he did, he went one step ahead. Now what he did was, he along with a couple of his friends, what they did, so one person used to put this place this particular product on the website. The other person used to go and buy it. So this way they showed the public that, look, this can be ordered online, and if you order online, it will be delivered to your house. So they actually demonstrated this. This demonstration alone took them the first 2-3 years, which means they placed the product and they themselves bought it. For what? Just to tell people that there is a concept like this. So first they had to educate the market about this. Look at the kind of perseverance. I don't know if many of us would have even survived to that extent, because he was at a peak time of his career, basically a time when his friends would have been working or going for a job or something like that. He was working on a model that was not even established, right? And few years down the line, people were actually seeing, what are these guys doing? There is something that's going on here. So they got fascinated, and slowly that's how the concept of all this e-commerce thing built in China. Parallelly, these players were there, Amazon and all these players were there. So the payment gateway provider, this guy, Elon Musk, had started a startup and all. Fine, we'll talk about all that on another day. But right now, in China, that's how it got started. And this guy had the first mover advantage. That is, there was no one else doing all this. That's how they started. And today, these guys are literally ruling the the Chinese economy with respect to e-commerce. With respect to e-commerce space, these guys are literally having the major stake there. And Amazon and Flipkart and all cannot even enter into. Forget Flipkart, but Amazon is generally a global brand. They can't even enter into China. That is the kind of monopoly that they have created inside China. But of course, as Chinese government is known for, right now this guy was a person who uplifted their economy. Now the government has gone against him for some reason, but forget that. But basically what happened was, this guy was completely pushed by the society by saying that you are having a crazy idea that is not even going to, that with which with which you are not going to go anywhere near your goals. But this guy broke all the odds and he proved them all wrong with a concept, with an ideology that he believed in, and he just sincerely worked towards it. So basically, the learning point that we all can take from this is, it's no matter what others tell about you, if you are determined about what you want to do, you will find 100 ways to make sure that that happens. As simple as that. So it's all about how sincere you are to yourself. And of course, that was a time he also said, you know what? The time when Jack Ma began Alibaba, he was 35 years. And 35 years in our society generally is like what? Almost that guy should be settled. Settled means in our society, it means what? He should have 10 to 5 job, a paying salary every month. Then he should be married with a couple of kids and all these things. Our society put all these tags and he need to get his house, all these things. He's settled now. He started off something new at a time, at an age when he was 35 years old. Just imagine, if you can relate that to whatever you are going through, maybe if you feel that you've taken multiple attempts in your CA exams, no matter what. Actually, there was a guy at that point of time who was dwelling with an idea that was not even established. While you guys are doing CA, which is actually a well-established course, you are guaranteed of a very successful career. Now, I don't think you are wasting your time. So if that is what you're thinking about, in case you feel that you've taken multiple attempts, don't even fall to that particular, don't fall prey to it. No matter what people are telling you, if you are very clear with your goals, yes, I want to be a CA. I want to do this particular course. Yes, just go and do it. That's about it. And you give your best and leave the rest, automatically a success will follow. That's about it, guys. So these are some very important and inspirational things that we can draw from people like, Jack Ma that I told you. So look at the kind of mental power that he would have got. The entire society was against him starting this particular startup. And today he has created a unicorn startup. It's like major, the valuation is like runs into billions of dollars. That's the kind of thing they have penetrated into so many things right now. It's a conglomerate. They have this, recently they introduced, not recently, a few years back, they introduced humanless hotels. That is, you can just place let's say you want to go to China, Beijing, or you want to go somewhere, and they have some literally luxurious hotels. There will not be a single human being there in that hotel, except for the guests. So no physical humans will be managing. They showed this once on I think CNN channel or somewhere, CNBC channel, I think so. What happens is a robo will receive you, and you would have you would have booked the room online and all. So that robo will give you a card, or I think your retinal scan, something of that sort. You just have to go stand next to the door will automatically open. So this is like a big multi-storied building with so many rooms like that. And you just need to just need to click on what food you want to have, and automatically that robo will knock the door. It will come inside and give you the food and all. They have made some kind of crazy thing that you and I can't even believe. You should go have a look at that factory. Just type Alibaba factory. Just type it on Google. Google it up, not Google it. You type it on YouTube. You'll see the factory will be, from one place to another inside the factory. The factory is generally big. So all these movements, unnecessary movements, they don't use human beings. They use robots. So it will be moving in the roads, and automatically if some roadblock comes, it can automatically sense that and it can stand. So they have used so much amount of technology. But not just that. By the way, Jack Ma, this guy, he doesn't have any kind of technological background at all. He just saw this concept of internet was amazing. He started it. That's all. He doesn't have any kind of technological background like computer science. He has studied some coding and all. No, he just said, I believed in this particular ideology, and I used to hire people who are smarter than me. This is what he says generally. Fine. And he hired, with this, he created an empire. That's about it. So even when the entire world is against you, if you are clear with your objectives, no matter what, you will be achieving it one day. But the thing is, you need to have the perseverance, you need to have the patience. So since that guy was patient enough, and the most important factor, yes, luckily he said, he met a girl who actually patiently waited for him. That lady, his current wife, she completely trusted on him when the entire world was saying this guy is good for nothing. Because literally he didn't have anything. At that point of time, he met someone, and she said, I will be there with you, and I will support you for whatever you're going to do in your life. And of course, the rest is history. Today, it's like globally, Jack Ma is a very famous guy. And of course, there are some controversies around him. It's like always Elon Musk versus Jack Ma. This guy Elon Musk doesn't like Jack Ma at all for some reason. So anyways, those things will be there. But yes, this is what I want to share with you all. It's all about the mind game, how strong you are with your objectives, and the perseverance is all that matters the most. So if at all you feel that you are lagging behind, your friends have cleared but you are left behind, ask yourself this one question: why did you sign up for this course? So you wanted to finish it, then no matter what, let's go and finish it. That's all. Clear? Yes, guys. So with this, so let's get started with a brand new chapter called as capital structure decisions. Capital structure decisions. Now, please write down. So you have written the heading here, capital structure decisions. Okay. So what you can do is pull an arrow and branch it into 4 parts. So I'm going to break this chapter into 4 parts and I'm going to study. I'm going to teach you. So in the study material, they have not broken it into 4 parts and all. But for a logical understanding of this particular chapter, a very beautiful chapter. So a logical understanding of this particular chapter, I'm just breaking it down into 4 particular subdivisions so that it will be easy for you to understand the entire subject. So under the first subdivision, write down. Under the first subdivision, write down EBIT-EPS indifference point. Indifference point. EBIT-EPS indifference point. Next, write down break even points. Break even, EVEN, sorry. Break even points, POINTS. It's a plural thing. We have something called as operating break-even point, financial break-even point, overall break-even point. We'll be seeing it. Then write down EBIT-EPS-MPS analysis. EBIT-EPS-MPS analysis. EBIT stands for earnings before interest and tax. EPS stands for earnings per share. MPS stands for market price per share. So we are going to see the relationship between these 3 and we are going to analyze. And finally, write down the most important part, capital structure theories. Capital structure theories. Capital structure theories. Done, guys. Right. Now, yes, this chapter we are going to break it into 4 parts and we are going to study a threadbare analysis. We'll be doing it. We will be delving deep into this chapter and understand one thing. Again, there is nothing to be mugged up here. Every single thing is conceptual, right? So please follow the logics. So whatever we have studied till now, we will be drawing some relationship with whatever we have studied till now as well. Like most importantly, your weighted average cost of capital. There is a cost of capital chapter, so that we will be seeing here together. Generally, some faculties, what they do is, so they mix that cost of capital chapter with this 4th subdivision of this chapter, capital structure theories, because they are interrelated. But I want to do it separately for a particular reason, which you will understand as we proceed into this particular subject. Are you clear with this, guys? Fine. Now, first, before we get into this chapter, first let us see what is this chapter's objective. Our subject, financial management, overall objective is maximizing the wealth of shareholders, which can be achieved by 3 objectives. What are the 3 objectives? Financing decisions, that is decisions that are taken with respect to the fundraising activity. Investment decisions, that is the decisions that are taken with respect to where the funds are deployed. And finally, dividend decisions, correct? Now, this chapter called as capital structure decisions, as the name suggests, goes on towards achieving the objective of financing decisions. Financing decisions, that is which source of finance should I take my capital from? That is, let us say alternative 1, I want to raise 100 crore rupees right? Alternative 1, fully from equity share capital 100 crore, or alternative number 2, equity share capital 50, preference share capital 50, or alternative number 3, it could be equity share capital 30, preference share capital 50, debt, let us say it's going to be 20, or alternative number 4, it is only going to be 60 of equity and 40 of debt. Now there are so many alternatives like this, we can keep on going. Sir, out of these alternatives, which is the best alternative? Yes, which is the best alternative? This basically, the composition of my capital is called as capital structure, correct? That is, the sources of finance is called as capital structure. It can have equity only, or it can have equity plus debt, or it can have equity plus debt plus preference. It can be any combination. So which capital structure is the optimum or the best capital structure is what we are going to see in this particular chapter. And again, it's an open-ended area. You cannot say that always this is the best. You cannot say always this is the worst also. Risk and return. We've already seen that risk and return trade-off is always there. More the risk, more the return. Clear with this? We will be seeing in this particular chapter. So out of the given capital structures, given alternatives. So in a case, generally this question, this chapter dwells about out of the given, let's say 2-3 alternatives, which is the best capital structure for this particular company. We need to do some computation and we need to arrive at it. Are you clear with this? It's not as simple as that, but there are certain things that we will be seeing in this particular chapter. That is number 1. Number 2, I know this particular word would have caught your attention. Capital structure theories. Now, generally, I've seen CA students feel that theory means something written in descriptive words and that runs into number of pages that requires to be mugged up. Absolutely not. Strictly speaking, theory means a proposition. Theory means basically a particular person's perspective on something is called as theory. I'm saying I can give you a theory, that is my view on a particular topic. Are you clear with this? Strictly speaking, that is the meaning of theory. So please don't worry. This entire concept, this entire segment is fully numerical driven. It is not some theory that I'm going to ask you to mug up. Are you clear with this? This is going to be we will be seeing 3-4 people have their own perspectives. They come up with their own propositions and hypotheses. We are going to learn that from their perspective. As simple as that. What it is, I will tell you. This chapter is fully numerical driven. There is nothing like that runs into pages that needs to be read and mugged up and all. Absolutely nothing of that sort. It's a fully a practical chapter. Clear with this, guys? I just wanted to clear this at the beginning itself. Clear with this? So this chapter is divided into 4 segments: EBIT-EPS indifference point, break-even points, EBIT-EPS MPS analysis, and capital structure theories. Are you clear with this? Fine. So this is the introduction to this chapter, and this chapter helps you achieve what objective? It helps you achieve financing objective. Financing decisions basically means what? Decisions related to fundraising activity. Are you clear with this? So they would have generally given multiple capital structures and they would have asked us, out of these capital structures, out of these alternative, which is the better one? Which is the best alternative for your company? Are you clear with this? You need to use all these tools that we are going to learn in this chapter. Based on that, you will be giving them a conclusion. Are you clear with this, guys? Fine. So now let us just get into this chapter. Let us get into the first segment, which is EBIT-EPS indifference point. So first, take down the heading, part 1. Take a green ink and write down part 1. EBIT-EPS indifference point. EBIT-EPS indifference point. Write down. It is the level of EBIT. Please write down. It is the level of EBIT at which the EPS under 2 different financial plans are the same. At which the EPS under 2 different financial plans are the same. EPS under 2 different financial plans are the same. It is the level of EBIT at which the EPS under 2 different financial plans are the same. Clear with this, guys? Yes, fine. Sir, what is this? What is this particular concept of EBIT-EPS indifference point and how to calculate this indifference point? Now, what we will do is straight away, let's jump to the first question. Let us read the question, and with that question, we will understand the concept. Clear with this? So, always remember, I won't even say subject wise, not even chapter wise, concept wise, there could be different strategies. See, this is not the way we learned the previous chapter. In the previous chapter, I explained so many things and then we entered into it. Right now, even if I explain so many things, you might not understand. So first, let's understand. Let's read the question. Using that question, I will explain the concept, and it is going to be a cakewalk. Very, very simple. Clear with this, guys? Fine. And there is a concept of indifference point in your cost and management accounting as well. That is different. This is different. This is technically speaking financial indifference point. If you want, you can call it like that. That is an operating indifference point, but let us see that in costing only. Here, indifference point is EBIT-EPS indifference point. Clear with this, guys? Fine. So please take the first question.
Page number 70.
70, yeah? Okay. Right. So please take the first question. Now read this question. Once we finish reading this question, I will explain what this is. So problem 1. Calculate the level of EBIT at which the EPS indifference point between the following financing alternatives will occur. Alternative number 1, equity share capital of rupees 6 lakhs and 12% debentures of 4 lakhs. Clear? What is the total capital? What is the total capital? 10 lakh. Or alternative number 2, equity share capital 4 lakhs, 14% preference share capital 2 lakhs, 12% debenture 4 lakh. What is the total capital? 10 lakhs. Are you clear with this? So assume the tax rate is 35% and par value of equity share is 10 in each case. Now basically what they are saying, look, I want to raise how much, guys? 10 lakh rupees. Alternative 1 for raising 10 lakh rupees is 6 lakhs of equity and 4 lakhs of debt. Clear? Or the same 10 lakh rupees I can raise through another alternative. 4 lakh of equity, 2 lakh of preference and 4 lakh of debt. Are you clear with this? So there are two different financial plans. Are you clear with this? And always remember, the concept of indifference point can be done only when you are comparing between two plans. Sir, I'm having only one plan. Which is the better one? What will you say? There's only one plan. There is nothing to compare. Clear with this? So always remember, the concept of indifference point comes into play only when you have two alternatives to compare. Why am I saying this? Because the next thing that we are going to see is something called as a break-even point. A break-even point doesn't require two different plans to be compared. In a single plan itself, you can find out the break-even point. We'll be seeing it later. But always remember, the concept of indifference point arises only when the time when you're comparing between two different alternatives. Are you clear with this, guys? Are you clear with this? Now, what is this they are saying? What do you mean by EBIT-EPS indifference point? Very simple. EBIT-EPS indifference point mean at what level of EBIT will the EPS under alternate 1 and EPS under alternate 2 will be the same. Are you clear with this? At what level of EBIT will the EPS under alternative 1 and EPS under alternative 2 will be the same. Are you clear with this? So if EPS under both the alternatives are same, which one is better? Which one is better? I cannot say that 1 is better than 2 or 2 is better than 1. I will only say both are equally the same. That's why I am indifferent. I am not different to both the alternatives. Are you clear with this? So what do you mean by EBIT-EPS indifference point? Read that. I have dictated something new. Read that. It is that level of EBIT at which the EPS under two different financial plans are the same. Are you clear with this? So how much should we calculate the EBIT level at which EPS of the first plan is equal to the EPS of the second plan? Now, how will you calculate this? How will you calculate this? How will you calculate this? Very simple. Equate the two. Equate the two. And then you can calculate EBIT. How it is? First, I will do it. I will give you time to write down. Don't worry about it. Right? Don't worry about it. So, question number 1. Now, guys, you tell me. We have how many financial plans? I will give you time to write down. Yeah, we have two financial plans, right? We have two financial plans. Branch it into two. Yes. So now the first financial plan, what have they said? So this is plan 1. This is plan 2. Yes. Tell me the capital structure. Equity share capital is equal to 6 lakhs. Perfect. Then 12 percentage debentures. No, 12 percentage debentures. How much is it? 4 lakhs. So how much is the total? 10 lakh rupees is the total capital. Correct? 10 lakh rupees is the total capital. Right. So now in plan 2, so how much is your equity share capital? Rupees 4 lakhs. How much is your so that's going to be 14% preference share capital. So PSC stands for preference share capital. How much is it? It's going to be 2 lakhs. Then 12% debentures is going to be 4 lakhs. So now first tell me guys, in this case, how much is the capital structure? How much is the total capital for this particular plan to 10 lakhs, correct? So plan 1 also gives you 10 lakhs. Plan 2 also has a capital of 10 lakhs, correct? Now tell me, because of the capital structure, will my EBIT be different? Will my EBIT be different because of capital structure? No. Why? EBIT means operating profit. Operating profit, that is profit that is generated out of my operations before considering my financial cost. So how do you generate the profit? By operations. This 10 lakhs I invest, correct? That 10 lakhs where it came from does not determine my EBIT. Because only after your EBIT you will be reducing your financial cost. Only then things will change based on your capital structure. Are you clear with this? Fine. Now what they are saying, calculate the indifference point. Meaning what? Calculate at what point of EBIT will the EPS under plan 1 be equal to the EPS under plan 2. Correct guys? Yes. Correct guys. So what should be the EBIT level at which the EPS under plan 1 is equal to EPS under plan 2? Now we should calculate what the EBIT only. Correct? Now can I say EPS of plan 1? Just tell me whether this is correct or not. Can I say EPS of plan 1 is equal to, can I say EBIT, right? EBIT minus 12% on 4 lakhs. How much is the interest? How much? 48,000. Correct? Right. So now EBIT minus interest gives me what? EBT. Correct? Can I directly put into 1 minus tax rate 0.35? Guys, correct? I am just preparing that statement in a single equation. EBIT minus 48,000 gives me EBT. The whole into 1 minus tax automatically gives me EAT. Correct? Minus preference dividend. Any preference dividend here? Nothing is there. So this is automatically your EAT, which is automatically equal to your EFE also. Correct? Divided by how many number of shares? How many number of shares? They said at the rate of 10 each. Correct? So it's going to be 60,000. Correct? Divided by 60,000. Can I say this is the EPS calculation for plan 1? Guys, correct? How did we get this? EBIT minus interest technically gives me EBT into 1 minus tax gives me EAT. Right? If there is preference dividend, you can remove that also, gives you EFE, the whole divided by the number of equity shares, gives you EPS under plan 1. Correct, guys? Now, what will be the EPS under plan 2? Can I say this will also start with the same EBIT? Why? Because they have clearly told that they've asked us to find out the indifference point, meaning what? The point of EBIT at which the EPS under two alternatives are the same, which means the same point only we need to find out, minus, in this case, what is my interest? 14% on 2 lakhs. Sorry, what's 12% on 4 lakhs? 12% on 4 lakhs. How much is this? This is going to be the same, 48,000. This gives you what? EBT, correct? Into 1 minus 0.35, right? Now, further minus what? Preference dividend. How much is preference dividend? 14% on 2 lakhs. How much is it, guys? 28,000. So this gives you what? EFE, earnings for equity, the whole divided by 60,000 or not 40,000. I'm sorry. Here it's going to be how much? How many number of shares? 4 lakhs divided by 10. So it's going to be 40,000. Are you clear with this? Are you clear with this, guys? Yes. So now what do you mean by an indifference point? It is the point of EBIT where the EPS of plan 1 is equal to EPS of plan 2. So let us equate the two. If we equate the two, what will we get? So if we equate the two, we will be having EBIT minus 48,000 into what is this? 0.65 into 0.65 divided by 60,000 is equal to EBIT minus 48,000 into 0.65 minus 28,000 the whole divided by 40,000. Guys, correct? So now the only variable that we've got here is what? EBIT. We can use this. We can use mathematical equation, cross multiply and all, and we can find out, guys. Correct, guys? Yes, that's about this. Now quickly tell me, let's just solve this together, and then you guys can note it down. Yes. So now tell me, guys, so what is this going to be? So this is going to be 0.65 EBIT minus, so 48,000 into 0.65. How much? 31,200. Minus 31,200. Okay, minus 31,200. The whole divided by 6 is equal to 0.65 EBIT minus 31,200. 31,200 minus 28,000 divided by 4. Correct, guys? Yes. So now what will happen here? So this is going to be 0.65. Okay, so can we cross multiply this? Take 4 here and take 6 here. Yes. So what we can do is, so 4 into 0.65, how much is it? 2.6. So 2.6 EBIT minus 31,200 into 4, how much is it? So it's going to be 124,800. Are you getting what I'm doing? So I'm just cross multiplying this with all these figures. So 0.65 EBIT into 4 is 2.6 EBIT. 31,200 into 4 is 124,800. Correct, guys? Is equal to 6 into 0.65 EBIT. How much is it? 3.9 EBIT, right? Minus, okay, we can add these two. So 31,200 minus 28,000 is going to be, sorry, 31,200 plus 28,000. How much is this? 59,200 into 6. How much is this? So 3,55,200. Yes, we have got this equation. Now you can take everything to one side. So 3.9 EBIT minus 2.6 EBIT. How much is it? 1.3. 1.3 EBIT is equal to, so 3,55,200 minus 124,800. How much is this? 230,400. So can I say EBIT is equal to 230,400 divided by 1.3. How much is this? Rupees 1,77,231. Are you clear with this, guys? Are you clear with this? Which means if my EBIT is 1,77,231, EPS under alternative 1 and EPS under alternative 2 will be exactly the same. Are you clear with this? Sir, why should we calculate this indifference point? I am coming to that, but first write this down. And guys, I hope you guys are clear with the mathematical calculation. Cross multiplication is simple. Cross multiplication is what I did, and LHS moving to RHS. Negative on LHS, if it moves to RHS, it has to be positive, and positive on LHS, if it moves to RHS, it has to become negative. So the sign alone needs to be inverse. Basic mathematics, I hope you guys know this. 8th standard, no, 6th standard mathematics. Clear? Fine. Come on, guys. I'm just scrolling it up. Please write this down. And I will also prove that at this point, plan 1 and plan 2 will have the same amount of EPS. And then we will see why we are studying this concept. That is more important. How to calculate is one thing. But I always tell you guys, knowledge is one thing. Wisdom is more important. It's knowing how to apply this knowledge in real life situations. So why should we calculate this? That is what we are going to see in a few minutes from now. Quickly note it down, guys. Quickly note it down. The two financial plans, you note it down first. You can do this in no time. Since we are learning it for the first time, yes, we are discussing and doing it. In exam, if this question comes, it's going to be a blessing for you. Can save a lot of time. Quick. Okay, I'm just scrolling it up. Write it down, guys. Write it down. Completed. Where are you guys? Okay, can scroll down now. Okay. The recorded mode students, in case you want something, can just pause and even write, but I don't think that will be necessary. Please catch up to the speed. Speed is very important. Done? Done, guys. So what do you mean by an EBIT EPS indifference point? It refers to the point of EBIT where the EPS under two alternatives are same. Financial plans or two alternatives are going to be the same. Clear with this, guys? Clear with this? Now, sir, how is it useful for me to take decision? You asked us to calculate one indifference point. We calculated. What is this indifference point going to tell us? Correct. What is this indifference point going to tell us? With this, what decision making can I do? This question is there or not, guys? Yes. Now we will see. We will get into that. But before that, this is not for exam. Quickly, let me just prove that plan 1 and plan 2 at a profit of 177,231, it gives you the same EPS. Let me just prove that this is not for exam. So plan 1, plan 2. Now, guys, you tell me. Yes, this financial income statement. What is it? EBIT minus interest gives you EBT minus tax at the rate of 35% gives you EAT minus preference dividend gives you earnings for equity divided by number of equity shares gives you EPS. Correct? Now, under plan 1, now if your EBIT is 177,231, please follow here. Yes, so first tell me what is your interest? What is the interest? 48,000, right? 48,000. So what's your EBT? 129,231, correct? Minus tax, how much is 35% on this? 45,231. So gives you an EAT of how much? 84,000. How much is the preference dividend? Nil. So what's your EFE? Enter 84,000, right? How many number of equity shares? 60,000. So how much is your EPS? 1.40. So in the first alternative, if I do, that is 6 lakhs of equity shares and 4 lakhs worth of debentures, if I go, how much net earnings, EPS, earnings per share to the shareholders, how much they are getting? 1.4 rupees. Now let us do the same thing for plan 2 as well. 177,231. Guys, you need not do this in exam. I'm just proving and I'm showing you. That's why I'm doing it in a blue ink. Correct? So tell me how much is the interest under this alternative? 12% on 4 lakhs. It's going to be 48,000. So the same 129,231. The same 45,231. That gives you how much? 84,000. 84,000. Preference dividend, how much is it? 28,000. 28,000. How much is this? 56,000. And number of equity shares will only be 40,000. Number of equity shares will only be 40,000. So the earning per share is going to be how much? Exactly 1.4. So this is what is the meaning of EBIT EPS indifference point. That is, if my EBIT is at 1,77,231, at this point, the EPS under two alternatives will be the same. Are you clear with this? Are you clear with this? No. No. The question here is the most important question. Please focus here. Please focus here. Then I will dictate. Don't worry. Please focus here. Very important. Indifference point is how much, guys? 177,231. Now, if the company is expecting to earn 177,231, exactly, should they go for plan 1 or should they go for plan 2? Either of the plans they go, it will give the same result. That's why it is called as indifference point. Clear with this? Now, guys, this is not explained in the study material. Let me tell you a very, very important thing. We are going to connect the leverage concept here. Now, leveraged, is it good or is it bad? It's a double-edged sword. Guys, carefully listen. Carefully listen. You're not going to get this anywhere. Leverage is a double-edged sword. Number one. Number two, why does leverage happen? Because the presence of fixed financial cost. Let's say we're talking about financial leverage. It happens because of fixed financial cost. Number three, when will leverage be favorable for you? When will leverage be favorable for you? When your EBIT increases or when your EBIT decreases? The magnifying effect. When your EBIT increases, your EPS also increases multifold. But when your EBIT falls, your EPS also falls multifold, correct? So EBIT is always favorable for me when I am growing, correct? When I am growing, that is when my EBIT is more. Yes or no? Yes, guys. When my EBIT is less, then I don't want leverage to work because it will work against me. Correct, guys? Correct, guys? Always remember this. If the company expects to earn an EBIT of less than the indifference point, go for that option that has a lower fixed financial cost. Why? Because in this place, if you have more fixed financial cost, leverage will work against you. Are you clear with this? I am repeating once again. Now, what they are saying, if your EBIT is exactly 177,231, whether you go for alternative 1 or whether you go for alternative 2, your EPS will be what? The same, correct? So should I go for alternative 1 or 2? Whether you go for any of the alternative, you get the same 1.4. But let us say in the next year, the company is expecting to earn only 1 lakh. 1 lakh is less than my break-even point. Indifference point, correct? So the company is expecting to earn an EBIT of less than the indifference point. In this case, I will always tell the company, look, go for that alternative that has a lower fixed financial cost. In this case, which alternative will have a lower fixed financial cost? Alternative 1 or alternative 2? Obviously, alternative 1. Plan 1 has a lower fixed financial cost. 12% on 4 lakhs, that's all. Here it's 14% on 2 lakhs plus 12% on 4 lakhs. Guys, clear with this? Fine. So I will say go for the alternative that has a lower fixed financial cost. In this case, I will ask them to go for plan 1. Why, sir? Logic, I am telling you. If you go for that alternative that has a more fixed financial cost, your leverage will be more, correct? But when your leverage is more, that will be helpful for you only when your EBIT is more. But when your EBIT is less, it will start working against you. So definitely don't go for the one that has a higher fixed financial cost. Are you clear with this? Look at the beautiful link of concepts between this particular indifference point and leverages. Clear with this, guys? Now, at exactly I'm expecting to earn 177,231. Sir, whether you go for alternative 1 or alternative 2, plan 1 or plan 2, you will get the same EPS. Guys, clear with this? Clear with this? Suppose the next year the company is expecting to earn a profit EBIT of 3 lakh rupees. Guys, 3 lakh rupees, which is more than the indifference point. Then what I will say, yes, now it makes sense if you go for that alternative that has a higher fixed financial cost. So now you can go for plan 2. Sir, why, sir? Because now leverage will start working in your favor. Are you clear with this, guys? This is where we read your leverage is a double-edged sword. Based on that concept, underlying concept, we have linked it with the concept of indifference point. Are you clear with this? Are you clear with this? This explanation might not be as such in the study material. It will be there. It might not be as such. This understanding might not be as such. I will not say all these kind of things for multiple areas, for all areas. Generally, some areas I know, generally students struggle. By self-study, they might not understand. If you can understand, well and good. They might not. That is the reason why I'm stressing and hammering on this particular area. Clear with this, guys? Clear with this, guys? So why do we calculate indifference point? Clearly, I know. Sir, which plan is best? Wait. It depends on your EBIT. If you are expecting your EBIT to be less than the indifference point, then it is better you go for plan 1 since it has a lower fixed financial cost. If you are expecting your EBIT to be greater than the indifference point, then it makes sense for you to go for that option which has a higher fixed financial cost because the magnifying effect will work in your favor and you will maximize the shareholders' wealth. That is, your EPS will increase. Clear with this, guys? Isn't it logical? Isn't it logical? Yes, are you clear with this? You have any doubt? You have any doubt? Guys, clear with this? Are you all clear with this? So with this, you can gauge and you can say, sir, always plan alternative 1 is better or always alternative 2 is better. It depends on where your EBIT is. Clear? I am just a startup, sir. The next year, I'm expecting to earn only 1 lakh. What will I do? Let us say you have a shop. You have a shop. You are starting a new business, right? Just starting. Now, what will you do? Two alternatives. Alternative one, will you go for a rented shop, or yes, I'm going to start a business. You will pay 1 crore, buy one big shop. What will you do? Obviously, you will not commit more on fixed cost, right? You will only have a rented place. As your business grows massively, now you need a big space. Now you will feel there is no point in me paying rent to this guy every year. Let me just go and buy my own property, and that's when you will buy. Correct? So when your sales or when you're in a growing phase, only then you will commit more with your fixed cost. That is on the operating side. Similar logic is there for the financing side as well. Are you clear with this, guys? Are you clear with this? This concept is called as EBIT-EPS indifference point. So to sum it up, EBIT-EPS indifference point means what? It is the point of EBIT where EPS of two alternatives are the same. Why do we calculate it? So at indifference point, alternative 1 and alternative 2 are both indifferent. That is, it will give the same result. If your expected EBIT falls below your indifference point, go for that alternative that has a lower fixed financial cost. If your EBIT falls above your indifference point, go for that alternative that has a more fixed financial cost. Logic, leverage effect. That's simple, guys. As simple as that. Anything difficult here? Anything difficult here? Guys, anything difficult? You look very confused. What happened? Yes? Clear with this? Fine. Right. Please write down. Please write down, guys. Please write down. Write down. Take a green ink and write down. Take a green ink and write down which plan to choose. Which plan to choose. Under that, write down number 1. If expected EBIT, write it fully, expected EBIT is less than indifference point EBIT. Please write it fully. I am writing a short form IDP. You don't write short form now. It is less than the indifference point EBIT, comma. Select that plan which has what? Which has, take a red ink and write down lower, which has a lower alone, write it in red ink, normal ink, fixed financial cost, which has a lower, put everything in caps, fixed financial cost, which has a lower fixed financial cost. Fixed financial cost. Right, guys? Done. Number two. What will you write? Come on, you can write it by yourself. Write down. If the expected EBIT is more than indifference point EBIT, comma, select that plan which has what? Which has higher fixed financial cost, higher caps red, fixed financial cost, normal ink caps. Lower fixed financial cost, here it is higher fixed financial cost. Clear with this? Clear with this? Choose that plan which has a higher fixed financial cost. Done? Done? Done, guys? Right? If you want, take a blue ink and within bracket write down logic. Within bracket write down logic. What is the logic? So write down, in this case, leverage works in your favor. In this case, leverage works in your favor. Don't just say leverage, because leverage can also not work in your favor. So for this second point, if you write that in this case, leverage works in your favor, automatically you know that in point number 1, it works against you. If you want, you can also write that. I'm writing in a blue ink. I'm asking you to write in a blue ink because this need not be formal. This is the logic behind, the rationale behind the analysis. Clear with this, guys? Clear with this? Spend more time on the concept, lesser will be the time you spend on the questions. As simple as that. Clear with this, guys? Clear with this? Fine. So line gap and write down point number 3. What is point number 3? Yes. If expected EBIT is equal to indifference point EBIT, comma, what will you do? Select any plan alone, you put it in red ink caps. Select any plan alone, you put it in red ink caps. Any plan. Done? Done, guys? Right? Right? So now, guys, so what you can do is, maybe you go home and try this as homework. Fine. Take one EBIT level. Let us say I am taking 4 lakhs as EBIT. 4 lakhs is above what? Above indifference point, correct? You take 4 lakhs and do the same statement, that is calculate the EPS for both the alternatives. Definitely the EPS under plan 2 will be greater than the EPS under plan 1. Why? Because of leverage effect. Clear? Now you take a point less than the indifference point. Let us say you take 1 lakh rupees of EBIT. You calculate, definitely plan 1 will be having a greater EPS than plan 2. Why? Because in this case, only the plan that has a higher fixed financial cost will actually bring down your EPS. Or in other words, a plan that has a lower fixed financial cost will be beneficial for you, because in this case, leverage is working against you. Are you clear with this, guys? Are you all clear with this? Yes, are you all clear with this? Please take this as a homework and do it. Try it by yourself. In a blue ink, you can try it on. Take one 4 lakh rupees of EBIT, one 1 lakh rupees of EBIT, and check the EPS for both these scenarios. So for the plan 1 and plan 2 at 4 lakh level, plan 1 and plan 2 at 1 lakh level, and you can automatically find out that it will always show this particular pattern. Are you clear with this, guys? Are you clear with this? Fine. Right. So please take down your library of adjustment. So please give all the cross-referencing. This is the 4th chapter. So write down calculation of indifference point. Calculation of EBIT EPS indifference point. Calculation of EBIT hyphen EPS indifference point. So I hope you guys have understood the logic for this EBIT EPS indifference point. So what is it basically? Indifference point is what point? It's a point of EBIT, right? Where the EPS of two alternatives are going to be one and the same. If you expect that, sir, which is better, which plan is better, you can't say that always a plan A is better, always plan B is better. No. If your expected EBIT falls below the indifference point EBIT, then go for that alternative that has a lower fixed financial cost. Logic, in this case, leverage will work against you. So you should not go for that option that gives you a higher fixed financial cost. In case your expected EBIT is going to be more than your indifference point EBIT, you should go for that alternative that has a higher fixed financial cost. Logic, in this case, yes, leverage will work in your favor, and then you can make use of it. So your EPS will be multifold. That is, it will increase in a exponential manner. It will be increasing in that telescopic manner. You will have a magnificial you have multifold increase in your EBIT. So in this case, that will be a magnifying impact. So in this case, it will work in your favor. Are you clear with this? This is the logic behind this concept of EBIT EPS indifference point. As I told you, there is also a concept called indifference point in costing, cost and management accounting. That it is different. It is a point of sale that is different. We will be seeing that later on, right? But here we are strictly talking from a finance perspective. So this is actually going to be your financial indifference point. Are you clear with this? And I hope you guys have caught up running notes for this. And this one is very, very important. This one is very, very important. That is breaking this chapter into 4 parts. That's very important, because this is not as per the study material, but I'm covering everything in the study material, but I'm doing it in an organized manner so that you can clearly appreciate what is what and which concept is covered under which bucket. Are you clear with this? This understanding is very, very important before we enter into this chapter. So slowly from this EBIT EPS, we'll move to this break even. Then we'll move to the next one. And finally, we will land at this capital structure theories and all. This chapter is going to be very interesting, but it has to be learned in a graded manner. You cannot directly jump to capital structure theories and just finish it off. If you learn it in a graded manner, you will understand the underlying logics behind this particular chapter. Are you clear with this? Right? So with this, I'm concluding this session. So please revise till whatever we have covered till now. I will see you all in the next one. So thank you all so much, and bye bye.